$500. Not 5,000, not 50,000, just 500. Set aside each month for 20 years. It sounds ordinary, almost boring. But history suggests something powerful. Small amounts, relentlessly invested, can quietly build financial independence. The real question is not whether it works. The real question is whether most people can stay consistent long enough to see it work. Let's begin with simple math. $500 per month equals $6,000 per year. Over 20 years, that is $120,000 contributed. On its own, that is disciplined saving, respectable, solid. But investing changes the equation. If that money earns an average annual return of 8%, the final value after 20 years would likely exceed $300,000. At 10%, it approaches $400,000. The difference between $120,000 and nearly $400,000 is not extra effort, it is compounding. Compounding is when returns generate their own returns. In the early years, growth feels slow. The portfolio barely moves, but over time, gains begin to stack. Year 15 looks very different from year 5. This is why investing feels invisible at first, and powerful later. The true power of investing $500 per month is not the amount. It is the duration. 20 years forces exposure to multiple economic cycles. Booms, recessions, crashes, recoveries. History proves that markets move in waves. Consider the Great Depression beginning in 1929. The Dow Jones Industrial Average fell nearly 90% from its peak. Fear dominated the country. Banks failed. Unemployment surged above 20%. For many, investing felt reckless. But by the late 1930s, and especially after World War II, economic expansion returned. An individual consistently investing through those uncertain years would have accumulated assets at deeply discounted prices. As the U.S. economy expanded in the 1950s and 1960s, those early investments compounded dramatically. The lesson is clear. Consistency during fear creates opportunity. The year 2000 marked the peak of the dot-com bubble. Technology stocks traded at extreme valuations. Optimism was everywhere. Then the bubble burst. The NASDAQ index fell nearly 78% from peak to trough. Investors who had placed lump sums at the peak and sold during panic, locked in heavy losses. But someone investing $500 every month from 2000 onward experienced something different. They were bought at high prices, then they kept buying as prices collapsed. By continuing contributions during the downturn, their average purchase price dropped significantly. Then came 2008, the global financial crisis. Lehman Brothers collapsed, credit markets froze. The S&P 500 fell more than 50% from its peak. Fear returned with intensity. Yet from 2009 through the following decade, the market experienced one of the strongest bull runs in modern history. An investor who maintained $500 monthly contributions through both crashes would have accumulated shares at both peaks and troughs. Over 20 years, the downturns would appear as temporary dips in a steadily rising long-term curve. Preparation means expecting volatility, not fearing it. Imagine two individuals starting in January 2003. Both earn similar salaries. Both live in the same city. The first decides to invest $500 per month into a broad market index fund. The second decides to wait for the perfect moment. In 2003, markets were recovering from the dot-com crash. In 2007, optimism returned. In 2008, panic reappeared. The first investor never paused contributions. In 2008, while headlines predicted financial collapse, they continued investing. Their $500 purchased more shares because prices were lower. By 2013, markets had recovered. By 2020, markets reached new highs. After 20 years, the first investor accumulated substantial capital. The second investor, who waited for clarity and certainty, likely missed the strongest years of recovery. The difference was not knowledge. It was behavior. In the first 5 years, progress feels minimal. The portfolio might reach $30,000 or $40,000. Encouraging, but not life-changing. Between years 10 and 15, compounding accelerates. Now the portfolio crosses 100,000, then 200,000. Investment returns begin exceeding annual contributions. That is the turning point. Money begins growing faster than deposits. By year 20, the majority of the portfolio's value comes from growth, not contributions. This is the quiet engine of wealth. Consider inflation. Over 2 decades, cash loses purchasing power, but businesses adapt. They increase prices. They innovate. They expand globally. Owning shares in productive companies means participating in that expansion. Over long periods, equities have historically outpaced inflation. This is why long-term investing is not speculation. It is participation in economic growth. There will be recessions. There will be crises. But history shows recovery has followed each one. From the oil shocks of the 1970s to Black Monday in 1987, to the 2008 financial crisis, to the pandemic crash of 2020. Markets fell sharply. Then recovered, long-term investors who maintained discipline benefited from each rebound. The real challenge is psychological. Can you continue investing? When your portfolio temporarily declines, can you remain patient? When progress feels slow, because 20 years rewards discipline, not excitement. $500 per month will not make headlines. It will not feel dramatic. It will not feel glamorous. But over 20 years, it can quietly build hundreds of thousands of dollars, not through prediction, not through luck, but through time. History shows that economies expand. Innovation continues. Markets recover. The investors who benefit most are not the ones who move the fastest. They are the ones who remain consistent. $500 every month for 20 years. It sounds simple. Because it is. But simplicity, repeated consistently, has built more wealth than complexity ever will.